Has anyone seen that it greatly affected the speed of interstate movement of goods? And with the introduction of GST, the time for interstate movement of goods has been greatly reduced. So we have already discussed the main features of GST, that GST has truly united us economically in the way that there is only uniform tax rate across the entire country. Doesn't matter where the end consumer is. And for business people, it has made the tax procedures really easy. So what GST has done for businesses is that it has improved the overall business environment of our country, which has generated investor confidence, which ultimately leads to more investment in the economy, which further creates more employment opportunities for the youth. Here we can see the GST rate spectrum. So there are multiple tax rates under the GST regime. You can see certain goods are not taxed at all, and certain goods are taxed at the rate of 5%, and further some services have been taxed at 12%. And you can see as we move from essential goods or services to the luxurious goods or services, the rate of GST increases. The rate of GST, the maximum rate of GST is 28% at present. Now let us truly understand what is cascading effect with the help of an example. Now let us imagine a hypothetical situation that there was a manufacturer in, say, Maharashtra state, and he was manufacturing cars, and he sells the car to a dealer B who was situated in Gujarat, Surat, and that dealer B sells that car to another dealer C who is in Vadodara, same state, and the dealer C again then sells that to a dealer in Rajasthan, which is an interstate supply. And finally the end consumer buys the car from the dealer D that is situated in Rajasthan. So let us see how cascading effect of taxes used to work in pre-GST era. So in pre-GST era, there was a tax levied on interstate supply by the name Central Sales Tax. It was levied by the central government. And there was a tax titled Value Added Tax that used to be levied on intrastate supplies. And there used to be another indirect tax titled Excise Duty that used to be levied on the excisable goods manufactured. So let us try to trace this transaction. For example, the manufacturer in Maharashtra, he sells this car to another dealer B who is situated in Surat. So at the time of clearing these goods, he would have to discharge, the person A would have to discharge the excise duty at the rate of 12.5%. This is the hypothetical percentage. And at the same time, he also had to discharge Central Sales Tax because he was engaged in interstate supply. Now when dealer B sells the car to dealer C, it was a intrastate supply because both of them were located in the same state. So dealer B had to discharge VAT at the rate of 12.5% for example, and he would collect that VAT amount from dealer C. Now, similarly, when dealer C sells it to dealer D in Rajasthan, it being an interstate supply, so dealer C would collect Central Sales Tax from dealer D. And dealer D, when he is finally making the sale to consumer in the same state, he will collect VAT at the rate of 12.5% from the consumer. So let us look at the figures. So these are the figures. So the manufacturer A in Maharashtra is selling the car at a price of 5 lakh rupees and is charging excise duty amounting to 62,500 rupees as well as central sales tax amounting to 10,000 rupees. So the total amount that he used to charge to dealer B was 5,72,500 rupees, out of which 72,500 rupees used to be the indirect taxes levied by the central government. Now, when he sells the car to dealer B and dealer B in turn sells the car to dealer C, the credit of the taxes that he had paid on the inputs was not available to dealer B because the input taxes were levied by the central government, and now dealer B is going to make an intra-state supply, and in case of intra-state supplies, the output tax was levied by the state governments. So in the previous regime, you could not offset the output state tax, you could not offset the input central tax against the output state tax liability. So this 72,500 rupees used to be a hidden cost for the dealer B. He had to pass on this cost to dealer C. He had no other option. So similarly, when dealer B sold the car to dealer C, in that particular case, since this was an intra-state supply, so dealer B would charge a VAT amounting to 75,000 rupees from dealer C, and the credit would not be available to dealer B. And now when the dealer C is finally selling the car to dealer D, which is again an interstate supply because both of them were located in different states. So dealer C would charge a central sales tax from dealer D amounting to 14,000 rupees. So the total amount being collected by dealer C would be 7,14,000 rupees. Now in this particular case, the credit of 75,000 rupees which he has suffered while purchasing the car from dealer B located in the same state is available. And finally, when dealer D is selling a car to the end customer located in the same state, he will again charge a VAT at the rate of 12.5%, that is amounting to 1 lakh rupees. So the total cost of car that the end customer had to pay to dealer D was 9 lakh rupees. And you will be surprised to know that the total amount of tax out of this final price was 2,47,500 rupees, and the entire incidence of this tax was being borne by the end customer. Though the previous pre-GST regime was not very pocket friendly for the end consumer. Now let us see how GST made these transactions